All right, so now we have that fair value gap right here, okay? Now, if you're using that as your entry strategy, or if that's your model, okay, it overlaps with multiple things here. It overlaps with these consecutive up close candles prior to this rotation lower, and that shift in market structure below that low there. So you got to go back inside all this price action here. Where's your up close candle? You can't use just this one because you're not getting the full picture. Because if you're demanding it trades all the way back up to the low of that candle, you're going to miss trades. You're going to miss them. Okay. So how can you manage risk appropriately? How can you still engage the market using an order block correctly? And as its author, me, I can tell you right now, this is what you do. Okay. The up close candles that are in succession here, one after the other, that entire range has to be defined. This range here, we have the high and the low. Okay, that is your range for a bearish ICT order block. Okay, in that range, you grade it. So we have the up close. We're not measuring this low here. Why aren't you using that low ICT? Because it's not an up close candle, and it's the time frame we're using here is the 5 minute. Why am I using the 5 minute chart? Because it's a high impact news driver day, and you're not allowed to trade with anything less than a 5 minute chart on a news impact event that's high impact. So this up close candle, that is the low end of your bearish order block, and then the high end is where the last up close candle, its high is. Okay. And now we put the lower quadrant, the midpoint, which is mean threshold, and the upper quadrant in the high. In an ideal world, just like the same logic when I'm using my fair value gaps, okay, if I'm trading inside of a buy side imbalance or sell side inefficiency, the scope is the same, okay? Ideally, I want to see a sell form between the low and mean threshold. That's the ideal, if you want to call it, optimal area of entry inside a range that is an order block. This is where you want to be looking for your shorts. Can it trade all the way up here? Yep. What happens if you enter in here and it stops you out? You just took a trade prematurely, and you wait and see, does it give you more indication that it wants to go lower, but it needs to leave the premium side that makes this range. So if it goes up there, you're going to have to wait for it to make a low, break the low, and then the next inefficiency after that, because then you'll have what? A market structure shift inside the range that acts much like what? A dealing range. So your order block is what? It's a dealing range. But it's very specific with this part. What I'm about to show you right now, this is what makes an order block an order block, okay? We're going to take this range here from the low to the high. Halfway point, that little area here, that's a sweet spot. That's your point of where the best of the best entries are going to form. So in this range here, what do we have? Well, we have a breaker. That's in the lower area too, lower half of the order block range. We have the fair value gap here, and we also have the optimal trade entry. How many things are there saying that this is going to go lower? Multiple, right? Any one of them could be your unique trading model. See, some of you don't realize I'm answering the question that a lot of you have been asking me. Why did you pick that and not this? Because I have a confluence of the things that I use and can employ as a trader to get into a trade. I don't just have one of my tools saying this is a trade. I have multiple things saying this is a trade. There's such a thing as technical science, and you're seeing it today. We're talking about very specific elements that repeat every single day. If you were utilizing this fair value gap here as the entry, where would your stop have to be? Not this. You can't be this high. This is the candlestick that creates the high of the fair value gap. In other words, that candlestick's low is the high. It's the high watermark of that shaded area, which makes my fair value gap. This candlestick's high is the low of the fair value gap. So the candlestick that makes the barrier high in a bearish fair value gap, that candlestick's high plus one tick is your stop loss. Entries, where's the best entry strategy for using an order block? When do you use the last up close candle before the down move in price? You'll have a series of up close and then maybe one or two down close candles, and then you'll have a down close candle right before your last up close candle. Okay, if there's a break in this, for instance, let's say this candlestick right here was a down close candle, or it would be a black candle for my charting, then I would have used that candle as my bearish order block, and none of this down here would have been a factor for it. How's that for simplicity? Real simple, isn't it? But if you ever have a series of immediate consecutive candles, you have to define the range that all of those candles make. Divide it in half, divide it in quarters, and the best setups are going to form below mean threshold, which is the middle of the entirety of the multiple candlesticks that make up my ICT bearish order block. Also, the importance of, if you're buying down close candles and you're treating them as a bullish order block, you absolutely do not buy a down close candle that's outside of the range that just broke. Okay? Never do that. Okay? Because you don't have the experience to know if that range being broken to the upside is going to be sustained. You don't want to do that. So what you want to focus on is this. If you think this is the part that's important, okay? You believe the market's going to go up here, and we traded, and now we created a dealing range, and I've already defined how to determine a dealing range, but your bias says it's going to go up here, okay? In this run here, that's your dealing range. Splitting that in half, like that, where is the ideal entry points for a order block? Is it down here or up here? You want to see a down close candle in the upper portion of this range right here. So it would be like this. In that area, that's your area where you would look for a down close candle in here. Okay? Caveat. Now this is an amplification of the lesson of me teaching the PD array matrix. My students that paid me did not get this lesson. So you're getting something fresh right out of the oven. If there is a fair value gap on the time frame you're looking at in this range or the lower half, you do not buy a down close candle in the upper portion because it won't hold. It will drop down and reprice to the inefficiency that many times will have a order block associated with the fair value gap. Those two together will be confluence, and you're in a discount here. And then you can reasonably expect to see the market do that. Okay, so that's why it's important that you start with one PD array, learn it, but it's not going to stop there. You're going to need to know the PD array matrix, even if you don't use them as entries. Understanding what they are and how they form inside of a price run, it's part of the whole process of determining, why do I buy that down close candle and not that one? Why do you buy that fair value gap and not this thing? How are you able to pick this PD array and you ignored this over here? I just taught you today. Right, thinking, man, this is, what is he talking about? Right, but the people have been doing this for a while. They just had an epiphany right there. They're understanding now why their down close candles they thought was a bullish order block went right through it and went lower, but still respected the dealing range. Didn't go lower than here. How do you know when to buy it down here and when to buy it up here? He's buying in a premium. Why is he buying in a premium? His video says, I just told you why and when.